How's it going, everyone? Big crowd, right? Okay, so let me introduce myself real quick. My name is Renato. I'm the managing director at Benzinga. I mainly put together a lot of these events. I joined Benzinga in 2019. I've started as a writer and eventually, just kind of grew up with the company. And today I'm joined by Brent Kochuba and Matt Cashman. And we're going to talk about options, which is kind of an extension of a passion of mine, markets, and I actually used to work at SpotGamma at one point. And so we'll kind of get into some of the things that they focus on right after a quick introduction. So Brent, you want to kick it off?
Yeah, thanks, Renato. My name is Brent Kochuba. I'm founder of SpotGamma. We started in January of 2020, and we specialize in understanding how the options market is driving the underlying stock or asset that those options are based on.
Matt?
And my name is Matt Cashman. I'm the principal of investor education at OCC, which is the largest clearing corporation of options in the world. If you're trading options in the United States, at some point in its life cycle, it goes through the hands of OCC in either the clearing or the settlement or exercise and assignment process. My job is to basically teach people how options work. So.
Awesome. And so I've been in touch with Matt over the years, and we actually did a similar panel to this last year. A little bit of a smaller audience.
Indeed.
But one really cool thing about Matt is that he started in the pits, and he was actually trading options in the pits. So he has a really good understanding of how options work, and he's seen them evolve through time. And so my first question to Matt is, why may options be viewed as a superior way to manage risk or participate in directional movement?
That's a great question. Why use options is essentially what you're asking me. Why should we trade options? I think the first answer to that in some ways is that the volume that you're seeing now kind of speaks for itself, and that the market in some ways is voting with its wallet. The volume that you're seeing over the last 5 to 10 years has basically doubled. As reference, this year, OCC is going to clear somewhere north of 12 billion contracts, which is a massive number. When I was trading in 2008, it was an extremely volatile year, and I looked up at the end of the year, and it was 3.7 billion contracts. So you can do the math there as to how much things have grown. But the word that I would use in support of options and optionality is flexibility in real terms. Using options provides you an incredible amount of flexibility as to how you actually express your opinion and the cost basis with which you use to express that opinion. They can be, you can do all kinds of things with options that you can't do with underlying products like stocks or indexes or commodities. If you're limited to the, just the long or short world of underlying products, that is the entirety of your position. You're either long or short. With optionality, you can do so many different things with the actual products that are so much more nuanced than that. So that's really my baseline use case for the product itself.
Sure. And so when you have a lot of those options trading, it can actually tell you a lot about potentially how participants are feeling about a certain, stock or underlying asset. Is that correct?
Yeah, absolutely. The more you educate yourself as to how the options work, the better you're going to be at deciphering what some of those theoretical signals are outside of the noise of the rest of the marketplace. I mean, Brent and SpotGamma are exceptionally adept at being able to spot signal within the noise. But my main message is the more you educate yourself as to how the options work, the better you're able to kind of theoretically read the tea leaves, as it were, to be able to see what that actually means for the underlying marketplace.
Sure. Now, Brent, I want to kind of move over to you. You've been in markets for a long time. And, at what point did you start kind of realizing, hey, there's certain things that I can kind of pick out from the way this market is trading that tell me, how a market may behave, over a very maybe short, even longer term time horizons? At what point did that kind of come as a realization?
Yeah, it was sort of the late teens was when we were monitoring S&P 500 index options, and that's the biggest options complex. It was back then, the dominant options complex. It kind of still is, and you could see when I was trading for a fund that was only trading the S&P 500, you could see strikes that had big open interest, the market would move to those strikes and would hold there. And so, you'd start to look into this and figure out, hey, why does the market move to these strikes? What is the mechanism to drive the market to these areas where there's big pockets of options positions? And so, that was really when it became obvious to me as a trader, kind of as a practitioner, looking at the volatility surface and looking at position on a daily basis. And then, so we spent January of 2020 to kind of January of 2021 telling people, hey, the options market's moving names, like in Tesla, for example, in early 2020. And then GameStop happened, and then suddenly everyone became a believer that, hey, options can really start to move these underlying stocks. And now the options volumes have only grown. They're growing by leaps and bounds, and you can see the impact of the options trading and hedging flows on a daily basis in a lot of these big names.
Nice. Matt, can you talk a little bit about what's kind of led to this increased participation in markets using options?
Yeah, I would love to say that it's due in large part to the OIC Investor Education Desk teaching people how options work. I think that's part of it. But I really think, going back to what I said at the beginning, the flexibility that these products provide is something that I think the marketplace more broadly is just waking up to and understanding how they work and how they might be a vehicle to actually express how you think about the underlying marketplace. It's an exceptionally flexible way to express those opinions. And so I think it's just, to be honest with you, it's a maturation of the marketplace, and part of that is also the actual democratization of the information that we have at our fingertips now. Many times when people ask me this question, like, what is going on? Why is the volume exploding so much? Part of my answer inevitably has to be that, well, there's just more information available to the everyday user, to the everyday, retail, pro-tail, even the institutional user has so much more information at their fingertips because there's just so much more of it out there that's available. Brent and I and his partner Matt were at dinner talking about 15 years ago how it was basically impossible to get a good option feed from Bloomberg, of all places, right? It was, and the way that landscape has changed over the last decade is incredible, and I think that's really what's going on here, is that we have so much more access to the information. When you have more access to the information, you just understand what's happening better, the entire landscape in front of you.
Gotcha. And I now want to move over to Brent and talk a little bit about, okay, so you see this increased participation in markets. You gave a good example of GameStop. What exactly were you seeing in stocks like GameStop, Tesla, even NVIDIA to this day? And how does that inform your opinion or kind of idea as to how that individual name may trade over very short-term time horizons from there on?
The interesting thing about options is because you can see open interest, you can see where people are positioned, and then you can compare that against what we call the volatility surface. And when you look at the volatility surface, there's information embedded in that. So just like anything else, supply and demand. When there's more demand, the prices go up, and when there's more supply, prices go down. And so you can see when people are placing bets over not just a variety of prices, but also throughout time. And so as you watch that volatility shift and as positions shift, you can start to understand the expectations that people have. And what's also interesting now is that you see as options volumes have grown, and we believe the hedging flows associated with those options volumes grow, it starts to change the price distribution. So what I mean by that is, if you look at Tesla right after the election, the market is pricing in, let's say, a 5% move in Tesla since Trump won. But we sit there and go, no, the distribution or the possible volatility is going to be much higher than that because of all this options flow. And so the interesting thing is that we've gone from being able to sort of assess how people are positioned to now understanding how that flow is likely to drive the underlying movement. And obviously for those that are watching, Tesla was up way more than 5% at the end of last week. It was up something like 25 or 30%. And so you can see this happen time and time again now, where the bigger the options market grows, the more flows come in, and the more people are focused on volatility and their view on the distribution of prices, is not just sort of how the stock is just going to move, but actually the volatility of how the stock moves.
Gotcha. And so, in recent years, a big thing has been a lot of conversation has happened around products that bake in options overlays into them to give participants exposure to underlying movement, whether that's up or down. How have you seen that potentially, impacting markets? And do you think those are actually good tools to kind of give participants that exposure to options that they may actually desire?
So there's a couple of big things. Number one, there's two giant funds. JEPI is the most well-known fund out there that has $30 billion in assets, and that's call overwriting, and that supplies the market with a lot of what we call positive gamma, which reduces volatility in the S&P 500. So you can see the fingerprints of that trade and the effects of that trade. But I have a question for you, Renato. Do you know how many ETFs hold NVIDIA stock?
I have no clue.
Anybody guess? Anybody? Nobody? 523. You blew me up with the 20,000 guess. I was looking for someone to say 5. No, 523. And a lot of those hold options positions now. So you can find triple levered NVIDIA ETF. You can find call overriding ETF. You can find short dated call overriding NVIDIA ETF. There's the SMH. So what you end up having now is that ETFs are starting to build these options positions, and a lot of them are just systematic, right? They roll very consistently, and those are all starting to have effects in the market. And as assets go into these ETFs and these products, that makes the options complex bigger and the impact of those ETFs bigger. And so, you can really see these fingerprints across the equity landscape, and it's really changing, I think, the price patterns in the market.
Gotcha. Matt, how do you think about educating people about these products that exist out there? Maybe people aren't able to kind of exert that, have that attention or be able to trade those options themselves. And so how do you educate them on the products that maybe exist out there like this?
Yeah, that's a good question. I think number one, the thing that you have to say is, I think on the whole, undeniably, the access that people have to these products is probably a good thing. That it, again, democratizes the amount of information and the availability of the optionality to everyone. The other thing that I think is that, and I posted something on LinkedIn a long time ago about this, is that structured ETFs, most of the time, they're not rocket science, right? They are kind of like, in its simplest form, they're like two pieces. One is generally a yield-bearing instrument, and then the other one is some sort of option trade. And what you're doing is taking the yield from whatever you did to generate yield, and you're using that and spending it or using it to lever some sort of options trade on it. That sometimes means you're buying puts and selling calls. Sometimes that means you're just selling calls or just buying puts. But it's important that people understand when you look at something like that, that the actual trade itself is not really that complicated. But what is actually happening is that there are some sort of fees that are built into how these things are structured. And so the education about the optionality is really important, but the education about how much you're paying to get that optionality is also very important, because there are alternatives to do that. You can go do that in in an index and do options on an index and get the same kind of thing. It's just not packaged up as neatly as it is when it comes as an ETF, right? And so I think that's important as well. It's important that people understand the fees that they're paying to put the optionality on, essentially in a kind of secondary way, right?
I would also just add that most of those ETFs on a total return basis are losers. So you'd better off just owning spiders, for example, as opposed to owning spiders and the JEPI fund and selling calls against that position. But that doesn't stop people from just piling more assets into these kind of overriding ETFs, as an example. So investor education is, I think, important there. As Matt says, you can do a lot better yourself in a lot of these cases, selling calls systematically.
Yeah, and so one of the things I think is the case is you have like the SPX, but then you have like the micro indexes. And if I'm not mistaken, you can have a spider's position, a SPY position, and then actually sell or trade options in that cash settled index, and it'd be offsetting too, right?
Yeah, and better tax treatment, 60-40 tax treatment,
Yeah.
all sorts of things, and no fees, no 2%.
Gotcha. So we're kind of running out of time here, but I want to ask each of you, what do you think, what has impressed you most in regards to options markets over the past year, and how does that inform your approach maybe going into next year?
I think the most impressive thing, to be honest, is the protracted amount of volume that we're seeing and the stickiness of the retail investor and how involved they are on a daily basis. It really, I mean, it's something that I thought might look like this, and then it might dip down, and it has not done that at all. It only continues to grow.
Yeah, we see retail and traders getting much more sophisticated now and being able to take advantage of options in a much smarter way. And then the second thing is the liquidity of the options market is very impressive. You know, through all the bumps and bruises over the last 2 years, weird things happening in markets, the market stayed pretty tight outside of August 5th this past 2 months ago. But other than that, the liquidity is great and it's very robust, and that's pretty impressive.
Thank you guys so much.